Hello, and welcome to the WPP Media Intelligence Podcast. I'm Kate Scott Dawkins. I'm joined by Jeff Foster, and we're going to break down the week's news and data like we always do.
Yeah, it's turned out to be quite a busy week considering we're about midway through July.
Summer is fading fast, I will say that much for sure.
Yeah, definitely, especially with all the news and getting into earnings season. It almost felt like it's the fall.
Oh, earnings. We are going to talk about earnings. We had this week Albertsons, Pepsi, and Netflix all reporting. So we're going to talk through anything they said about the economy, audiences, media, marketing. We'll get into all of that. But let's kick off with some economics news this week. Nitty's still on vacation, so I'm afraid it is mostly US focused. But, that does have knock-on impacts for the rest of the world. We'll get into the US economics piece here first, I think. Lots of new data out this week.
Yeah, so we had the big inflation report earlier this week. So the headline number was inflation was up 2.7% year over year in June. And that was from 2.4% in May. So looking at the top line numbers and then digging a little bit deeper, excluding food and energy, core inflation was up 2.9% year over year in June versus 2.8% in May. And then gasoline was up 1%. From May this past June. Well, grocery prices were up just 0.3%. Looking at some other interesting things in the report, appliance prices jumped for the third straight month. Toys, clothes, audio equipment, shoes, and sporting goods all got more expensive. Probably no surprise since most of those are heavily imported. And then an interesting little nugget in the report, rent rose 3.8% in June year over year, which is the smallest yearly increase since late 2021. Now, for me in New York and, knowing almost everyone who rents, that seems pretty low, but I guess nationwide, that is a little bit of a relief.
Yeah, there were also, I thought they said shelter was a key driver of the growth for the month, right? So it is still a larger increase than other categories. So even though it is lower, if we look at what was driving the headline number, shelter was a big piece of that. And we should say these are the CPI inflation numbers, not the PCE inflation numbers.
Correct, yes.
So not the Fed's preferred metric, but certainly something that goes into all of the thinking about whether we're going to see a rate decrease anytime in the near future or not.
Yeah, and I think we have a Fed meeting coming up. When is it? Next week.
Okay.
So we should hopefully get some clarity on that, although that's a whole other conversation on what's going on with the Fed. But who knows? We'll see how that shapes up by the end of the summer.
We won't do that here today, I don't think. We also had retail sales data this week. Headline, a seasonally adjusted growth was 3.9%, so ahead of inflation. The ex motor vehicles and parts was 3.3% growth. So actually auto and motor vehicle dealers were up 6.9%, which we're thinking, some pre-loading, trying to get ahead of either when the EV tax credits dry up in September or just ahead of sort of steel and import tariffs there, probably.
Yeah, it sure looks like that. I think that's probably what's going on. I would say is probably a combination of both, with the EV credits set to dry up, and then anyone who's in the market for an imported car would probably be heavily considering making that purchase sooner than later.
Yeah. So there were a few other interesting numbers, and we're going to pull on threads where we're getting hints. The data is fascinating, right? There are more sources of data in the world than we could possibly hope to get through or analyze in a lifetime, let alone a single week. But I always find it interesting, these little hints of what you see in the data that you might be able to interpret in terms of the health of a consumer, right? And here, primarily US consumers, but things to look at for our listeners who are in other markets, if you can find similar data. Building materials and supplies were down 1.1%. Whether that maybe is a nod to homeowners taking on fewer projects, given a little bit of uncertainty in the economy and future prices. Those appliance prices are increasing, so maybe that's not the time to take on a remodel, which bad news for me since I'm currently in the middle of one. But yeah, that was interesting. Food and beverage stores up 2.5%. Not necessarily yet seeing the impact from tariffs, say, on Mexican produce and tomatoes yet. That was in the news this week. Health and personal care stores up 8.3%. which mirrors commentary from Albertsons, who said that pharmacy sales were a driver of their growth. There were some questions in the Albertsons transcript about how much of that was due to the GLP-1 drugs, which are still impacting all of that. So those pharmacy sales, but that was a pretty big number. And then the other one I thought was interesting that I pulled out for us to talk about, non-store retailers, which is primarily e-commerce here, up 4.5%. But in May, that year-over-year increase was 7.7%. So that's a potential pullback from maybe Temu and Shein
Yeah,
and some of those online
it
marketplaces.
sure
That was an
suggests
interesting
that.
one. Yeah.
Yeah. I mean, it's interesting to think just how big of a market that they have for on the e-commerce side, and that would certainly suggest that there's, something at play here with the tariffs.
Now they take a sample. In fact, it may not even be that they have data from those companies since they are China based. But if we think about in general, either tariffs or de minimis changes in the US, whether that had some kind of impact on those e-commerce retail sales numbers. All right. Well, I did see one other chart, and maybe we'll put it in the notes or on LinkedIn when we post the podcast. The New York Times had an article about the economy and when we might see impact from tariffs or why we are not seeing it yet. And they mentioned a study by Alberto Cavallo, a Harvard economist, and two co-authors looking at prices for individual products from online retailers specifically, because that allowed them to identify where the goods were produced. And the New York Times article says they found that prices for imported goods, particularly from China, had outpaced those of domestic items since the tariffs took effect, although prices have moderated somewhat in recent weeks. And there is in this chart quite a divergence between the rise in prices for imported goods versus domestic goods. So I think we are starting to see some of that flow into the economy. It's just where it's showing up in the data yet, where not yet, which is really interesting to try and track all of that.
Yeah, and of course, I don't think this is a huge surprise. It kind of aligns with what we were thinking, that if we would see this impact, we'd start to see it in the second half of the year. So this seems like it's, would be expected in some degree.
Yep, absolutely. All right, well, let's kick off earnings. Oh my gosh,
Yeah.
we're here again. It begins. It was it's a slower week. We had kind of three big ones we'll talk about today. We can kick off with Albertsons. Of course, Albertsons, a large retailer, also a large retail media seller. And one of the first things that stood out for me in reading their transcript was how they talk about their, quote, media collective. That's how they talk about it. It was the second mentioned strategic pillar of their 5 strategic sort of initiatives for the coming years. So that really speaks to how important this business line is now to them and how they're organizing everything. They talk about how the data from their e-commerce growth is piling into that. The increased number of loyalty customers is feeding into that. You can really see how they're thinking about and building this sort of flywheel for that media business.
Yeah, I mean, they've been investing heavily in it over the past 3-4 years or so, and I think you're beginning to really see the effects of that coming into focus now.
Yeah, so what else? The digital sales for the quarter, which is their first fiscal quarter, but our second calendar quarter, digital sales increased 25%. They now represent 9% of total grocery revenue in the quarter were e-commerce sales. And that is a pure number. That is just the retail sales number. They said there's no media revenue in that e-commerce figure. So that's just the retail number. And they said, well, our e-commerce penetration is still below industry peers, looking at growing that. And they also said from a profitability perspective, the e-commerce business is near break even and improving. So they talked about, it's always interesting, these insights into this, right? They talked about there are just certain fixed costs that come when you are developing e-commerce and digital fulfillment, right? You have to build out the area in store where you're going to handle that.
Mhm.
You have the cost of the people who are doing the picking and all the tech platform stuff. So it sounds like it's now getting to be a big enough piece of business where that's going to be profitable, all those costs that they built to stand up the business.
Yeah, and it looks like there's just a lot of room for growth there as well. So something definitely keep an eye on in future earnings.
Yep. They talked about pharmacy. Our digital platform in pharmacy and health grew 20%. Cross shoppers between grocery and pharmacy are exceptionally valuable. Over time, these customers visit the store 4 times more often and buy significantly more groceries with us. So, again, thinking about how all of these different aspects of understanding the customer can benefit, lifetime value. What else did they talk about? They talked about within the media platform, investing in solutions that will support both endemic and non-endemic partners. So obviously they're looking at building out those media solutions for folks that are not just selling goods within Albertsons stores, which I thought was interesting. And then they talked a little bit about the consumer financial health and
Mhm.
behaviors. Again, when we're thinking about what data points show that consumers are starting to get a little bit anxious isn't the word, but like where are we starting to
Mhm.
see those first cracks?
Yeah.
So they said, quote, we continue to see the customers seeking value. We're selling more on promotion. They also saw increases in the shift into pork and ground beef as one example, or strong growth in our deli chicken business as an example, knowing that, quote, I think customers are always looking for quick and easy meal solutions. And so when we think about trading down, or there are multiple levels of this, often CPG companies will talk about wanting to prevent consumers from trading down from a CPG brand to a store brand. Albertsons talked about promoting their store brands.
Mhm.
But then also these other things like switching from a cut of meat, like a ribeye, to a pork or a ground beef.
Yeah, and it's interesting because these are pretty similar to historic trends that you've seen it throughout pretty much throughout recent history
Yeah.
when inflation kicks in or people have questions on where the economy is heading to see these you start seeing these sort of like mini, as you said, like downgrades or substitutions for in purchasing. So I thought that was really interesting.
Yep. One thing on tariffs, the management said, quote, well over 90% of the goods we source are domestically based. But to your point, ingredients are certainly playing a factor in our CPG partners and their cost of goods. So we're starting to see increases in cost of goods moving forward. They talk about their first line of defense being to push back on vendor partners, looking for alternate sources of supply. And then, quote, finally, in certain cases, if we have to, we'll pass them on to consumers. So doing everything they can, but
Yeah, I think that
yeah,
was interesting. Just, I think it's interesting that they're saying it publicly that they're going to pretty much do everything they can to control costs and passing on to the consumers. My read is sort of like their last option and least desirable one. So I
yeah.
think, that kind of shows you where they're positioning themselves in the next few quarters.
Yeah. Well, talking about CPG, we also had Pepsi this week. What did we learn from them?
Yeah, it was actually a pretty good earnings from them. Net sales were up 1% to $22.7 billion. There were organic revenue, excludes acquisitions, divestitures, and foreign currency was up 2.1%. They are still seeing softer demand for some of their products. Their worldwide volume fell 1.5% for food and was flat for drinks, and that excludes any currency or foreign exchange issues. And then looking at North America, that the CEO said that the domestic business was improving. However, there are still I guess some bumpy roads ahead would be the best way to describe it.
Yeah.
So the North American food division, which includes Frito-Lay and Quaker Foods, saw its volume shrink 1%, and the domestic drink segment saw volume fall 2% in the quarter.
They've been underperforming Coke in this category for
For
several quarters. We've been
Yeah, for a
watching
while.
that in our CPG model. Yeah.
Yeah, and they did say a few interesting things, addressing that. They did say that the volume for Pepsi, regular Pepsi, the good old-fashioned Pepsi, rose during the quarter, and Pepsi Zero Sugar saw a double-digit volume growth. So it's kind of interesting that the regular one, trying to see if there's any health trends in there, but it's kind of seems like both were the regular version and the lower calorie version were both doing a little bit better. And then they mentioned how they're relaunching Lay's and Tostitos to focus more on their core ingredients, which are potatoes and corn. So it sounds like they're
Okay.
really fine tuning some of their food offerings.
Anything about sales and marketing expenses?
Yeah, it was real interesting in the transcripts. They did have a comment how they're evaluating how they spend their marketing dollars to make sure they're getting the best return on their investment. So that was
Fine.
yeah, it was a
It's
little
like
vague, but
not saying anything really.
yeah, not
All
not
right.
saying much. They did talk about leaning into the protein craze. That thought that was interesting, and also a little bit more about physical like getting shelf space and that sort of thing as well.
Again,
But not a little.
GLP-1, right? Because people are trying to figure out. There was an article, I don't remember where I saw it, about whey protein coming back because people on GLP-1 drugs were needing sources of
Of
protein and
protein,
yeah,
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 yeah. So I think, as those drugs remain incredibly popular and high demand, I think
yeah.
you'll start seeing these shifts in behavior. But yeah, they did not provide a lot of details on what that meant for their marketing side, but they did mention it.
All right. Well, Netflix then. Let's get
Yeah.
into the meat and potatoes rather than
Y-
the corn and potatoes of the
Yeah,
media
exactly.
industry.
Yeah, so Netflix reported yesterday at the time of this recording, and again, very solid earnings for Netflix, as has been the case. Their second quarter 2025 revenue was $11.8 billion, which came in slightly above expectations. That would be up 16% year over year and 17% on currency neutral. It's really, really interesting. US and Canada up 15% on an as reported basis. Of course, there were recent price hikes that contributed to that. And then for full year guidance, they raised it to 44.8 billion to 45.2 billion. That was up from 43.5 to 44 in their prior guidance. They
Yeah.
talked about momentum from membership growth and ad sales. So
Which they're
yeah, it
not
was
reporting either of
right.
those figures
They
right
are
now. But
correct. We are
yeah.
still in the early phases of them not reporting. They did not offer a lot of details on that. They just said subscriber growth was ahead of forecast. So,
I mean, it's impressive though when we think about constant currency growth accelerating, right? I
right.
mean, a little bit fine. It was 16% in Q1,
You're right.
17% in Q2. That's pretty good. And then
Yeah.
expecting that to be stable through the full year. So they're still obviously seeing plenty of places to expand and either, take share in other markets. There was
Market.
a
Mhm.
return to growth in US and Canada as well, right?
Yep. Yep. Correct. And I think the pricing increase went into effect. When was it? Earlier in the year, right? January, February.
Yeah.
So
So
obviously
starting to
that
see the benefits of that
yeah,
too.
that was a contributing factor as well. And then, of course, Netflix is an ad seller as well, as we all know. So they did mention that they reaffirmed that they want to roughly double their ad revenue in 2025, and they are on track to do that. They did mention, of course, it's off a relatively low base, and they did provide some color on the upfront ad sales, saying they're nearly complete and the vast majority of deals have closed already. So
Yeah.
they seem
So I
pretty
think by
optimistic.
our estimates, that means they're looking round about $2
2
billion by
billion.
the end of
Yeah,
2025, give or take, right? Yeah.
correct. Yeah.
Which would still not put them into our top 25 list, but
Uh,
definitely, growing quickly.
with that rate of growth, we'll see, but I would not be surprised if they crack that sooner than later again.
Yeah, we did this math like a couple shows ago
Yeah.
or something, right? Certainly by calendar year 27, we'd expect them to be in that set of top 25 advertisers. You could be looking at something like, over 4 billion, 4 to 4.5 billion, maybe if we've sort of modeled out getting to a, um, 10% ish kind of
Right.
level of of revenue in advertising by 28, 29.
Yeah, exactly. And, well, they didn't really get into specifics. They did cite ad sales and their ad tiers as engine for growth. So clearly it's just, an area that they're focusing on a lot.
Yep, and then content, anything on sports too. Obviously, that's been a really keen area where we've been watching them talking
Yeah.
about. I know earlier this week, you and I were talking about the FIFA rights
Yep.
potentially coming up.
Yeah, no. So they did get the question from analysts, and they did a pretty good job of not really answering it, just saying they're very happy with their current strategy to focus on big live events that have a global impact. Nothing has changed as far as that goes. They did talk about the excitement for their NFL games coming up. So that definitely seems, like reading into it, nothing has really changed. The big type of events, the boxing matches, those sort of things that definitely are on their radar. And of course, the elephant in the room with NFL and World Cup rights perhaps being in play for pretty soon. That did not get directly addressed, though. So
Yeah, no, of
read into
course.
that as you will.
I wonder if Fox ends up talking about it or how much they're willing to
Yeah.
put in to keep the FIFA business. And There's a bit of a kerfuffle about the last rights and various investigations into
Right,
FIFA as
yeah,
well last time. So,
can get a little
um,
complicated, yes, to put it
yeah.
mildly. But you know, like looking at it, especially for North America, FIFA World Cup would definitely fit every criteria that Netflix has publicly said. You know, big events, concentrate, you know,
Global
concentrated
fan
all
base.
global
Yeah.
fan base. This sure would, you know, check a lot of those boxes for them. But yeah, it'll be interesting to see. And there's also been some speculation that some of the broadcasters might try to preemptively renegotiate renewals with the NFL before the early exit
Mm.
kicks into place. So I think we'll start seeing a lot of activity of that pretty soon.
I mean, what does Fox do in that case, right? Because I mean, they've had historically NFL, and they get a lot from the
Hmm.
years they do have the Super Bowl
Super
in
Bowl.
terms
Mhm.
of like a huge
Yeah.
portion of their
So
annual
yeah.
ad revenue. And then the other thing they have is FIFA, and that gets a
Yeah.
call out in their earnings as well. It's enough of a bump. What I think like
Hmm.
200
Yeah.
plus
Million.
million
Yeah.
dollars the last time they had a World Cup, maybe, or something like that.
Yeah.
If I'm this is a lot. I'm like trying to see
Mm.
the Excel cell in my spreadsheet in
Right.
my mind. So I mean that's sizable, but they don't necessarily have the kind of content budgets that
Right.
they are not on our sort of list of top 7 or so content spenders, where you have the Google, YouTube's, Amazon, Netflix,
Netflix is
Disney of
sure.
the world. What does that look
Yeah.
like?
You know, I mean, I think there's a bunch of scenarios at play. You know, probably the best case scenario is that they keep the current package as is, but you're going to be paying a lot more, so that's going to, you know, impact margins. You know, pricing on sports inventory, NFL you know, specifically is already pretty high, and this, you know, it's pretty premium price. You know, I guess you'd have to take a long, hard look at the spreadsheet to see when you know, what the margins start looking like and what you can actually charge in the market before, you know, advertisers might, you know, start thinking if that's like the best way to spend their money. So I think it's an interesting one. It did, you know, there's no easy answers. The other thing is that there was a interview with Roger Goodell, who of course is the commissioner of the NFL, about a week or so ago, and he heavily implied that they were looking at an international package as well. So do they create a totally new package? Do they give a lesser package to the broadcasters to sort of spread this out? So I think there's just a lot of what ifs right now.
Yeah, I mean, that makes sense for an American sport to
Right.
partner with a global
Global,
media owner who can take an
exactly.
American sport to other places. With FIFA, they're going to get rights deals in every
Every
individual market
yeah,
because there's such a strong global audience, right? So there's less of a need to rely on, say, for instance, a Netflix or an Amazon, unless they're coming to a league and saying, we're going to give you a price, but that means we need to own it in, all of these places to make it
right,
worthwhile. You have timing issues, you have all sorts of issues with that.
right.
But it is certainly interesting where we think that nets out. Um,
Yeah.
yeah. Okay.
There'll be, quite a space, and then there was one last thing on Netflix that which was pretty interesting. The analyst, asked a question if Netflix was interested in owning any of the legacy media networks for sale that may be for sale, you know, meaning
Mm-hmm.
Turner, the Warner Brothers Discovery networks, perhaps the Paramount networks, perhaps the NBCU spinoff, and, their CFO, Spencer Newman, responded, "No," pretty much. So they
Yeah.
have no interest in owning legacy media. He mentioned that they prefer to be a builder and not a buyer.
Yeah.
So I
Unless it
don't.
comes to games studios, or I mean, they've bought plenty of things
Right, right.
also, but
But
not legacy media seems like the most important part of that
right, I
statement.
don't think we should expect to see Discovery or Turner
Yeah.
on Netflix anytime soon.
Although speaking of Paramount, also, did you see the news that they are ending the Late
Yeah,
Show with Stephen
with Late
Colbert?
Show. Yeah, they cited economic reasons. I actually pulled it up at SMI. I was just curious just to see how much you know, an ad revenue. Of course, it doesn't paint the full revenue picture, but it could, you know, give you a pretty interesting insights. So Stephen Colbert, the franchise in 2019 and 2020 was peaking at about $150 million in advertising revenue, and in 2024, that was down to 80 million.
So halved. And I think I
So
saw a
half.
similar figure
Yeah.
across all of late night, right?
Yep, which is yeah, it's not unique to him, it's just
Yeah.
late night in general, and if some of the reported salaries are true with the host, the production shows, the writing staff, these are not cheap shows to produce, but it was interesting to see that, that was their reason.
Yeah, I mean, feels in line with everything we've been talking about, especially in this shift from professionally produced content where, again, everyone's sitting down. It's important to watch at the same time because that's the only time it's going to air, right?
Yep.
I'm more likely to watch snippets of these on YouTube Shorts or something later, right? Doesn't the timeliness of it doesn't matter quite so much. I'm also likely to watch a Josh Johnson skit on YouTube, right? As
Right.
opposed to sitting and watching a full hour of Colbert necessarily. So there are just these shifting behaviors amongst audiences that are obviously making that a less attractive or less viable solution. It doesn't have the same kind of draw, even though it's live and
Right, it's
topical, as, say, sports does. And so that just feels like there's no coming back from that one.
exactly. It's, there's the sense of urgency. If you've missed it, you can probably catch it if it goes viral, a segment or a bit on YouTube the following day or wherever it's distributed digitally. So like that urgency to see it live and in the moment is probably a lot less than you, as you said, like sports or some other types of content.
Or I mean, this is interesting though. Like, where does American comedy go then?
Yeah.
Comedy Central is tied up in the Viacom Paramount deal.
Yeah.
We've never done panel shows the way, say, the UK
UK,
has.
right.
And that's actually a lot of the TV that I watch will end
Right.
up being What I Lied to You or 8 out of 10 Cats Does Countdown. This sort of rich tradition of panel shows in the UK that we
Yeah.
just don't
Well,
have. And we're like now
yeah.
losing them even more so.
I do have a theory on that. I think as
Okay.
broadcast as content costs get more and more expensive on the scripted side, this usually leaves an opening for lower cost programming, which lends itself very well to like panel type variety shows. So I wonder if we're going to start seeing a resurgence in that type of content. Like the Who's Line is it when it peaked in
Yeah.
the U.S. probably about what maybe 20ish years ago or
Oh,
more.
yeah.
Yeah, but
Carrie and those guys. Yeah.
you could see, it's very similar to reminds me different macroeconomic reasons, but reminds me, early 2000s when you saw this wave of like European programming, especially UK programming and formats finding their way into the US, whether it's game shows and panel shows, just because it was a relatively cheaper way to fill the hours. So I wonder if
Yeah.
we're going to see similar trends if more and more companies start spending money on sports, which will take away entertainment budgets. Just a thought.
Mm. Okay. I mean, I'm all for more comedy panel shows.
Right.
I would love, I don't know if it would work as well, but like a US version of Taskmaster would be great. I found my
Right.
people, by the way. I was at an event last weekend with a bunch of brilliant thinkers in the sort of science and microbiology, genetics, robotics space, and mentioned that I like Taskmaster. I was talking to a couple of folks, like, we love it too. I was like, yes,
Maybe you're ahead of the curve here. So when it
something.
finds its US adaptation,
Yeah.
but you'll be first to know.
I also learned yesterday that Alex Horn, the guy who actually created the show, is an alumnus of Sydney Sussex College at Cambridge, which is
Oh,
the college that I was at when I did
very
my MBA there.
very nice.
Yeah, I have a nice tie to
Yeah,
Taskmaster as well. All right,
that's
that might be
great.
enough airspace for Taskmaster on today's podcast. Dear. All right, well, next week, in terms of earnings, we're going to get even more of a steer on what's happening in the economy. Let's quickly pull up what that looks like. We're going to have Coke. We are going to have Rogers in Canada. We're going to hear from Keurig Dr. Pepper. So we'll have all the like the biggest non-alcoholic beverages company, a bit more US economic data, Charter Communications, and Televisa Univision, plus Google, obviously.
Yeah.
IBM, some big players next week. So we will catch up on all of that in a week's time, and we'll have Nitty back. Yay.
Yeah, that'd be great.
All right. Thanks for listening, everyone. As a reminder, the Media Intelligence podcast is meant for informational and entertainment purposes only and should not be taken as financial advice. We will see you all or talk to you all next week.